On today's Hot Sheet, I'm discussing Fannie Mae's economic developments update for January, home seller profits, and the weekly unemployment report. Today is Thursday, January 23, 2025. I am Byron Lazine, and the Hot Sheet starts now. Good morning. Welcome into the Hot Sheet. Let me know in the live chat which market you are tuning in from. I see Bedford, Virginia, Milford, Connecticut, Nashua, New Hampshire, Northwest Arkansas, New York. Awesome. Let us know where you're from. Let's all get connected together. And let's dive right into the Fannie Mae economic developments for January. Okay, they come out with this report every single month. Obviously, this is the January report. Pretty basic breakdown there. But we want to watch this month to month and look at how Fannie Mae is thinking about their initial projections for this year. A couple of them stand out to me right off the bat. One of those would be existing home sales. Are they feeling more or less bullish on existing home sales? Why? What are the impacts on existing home sales, right? Obviously, when you look at total home sales, that impacts new construction. New construction is going to be, there's going to be a smaller segment of the real estate professional, real estate agent that has access to new construction, new development, depending on the market they live in or depending just on their skill set. So I like to look at existing home sales more because when we're looking at the agent, the broker business, existing home sales makes up the vast majority of that. You get into new development with national home builders. A lot of times that gets brought in-house, okay? And then you just look at different markets. Northeast doesn't build. Really, primarily the majority of the building, again, Texas, Florida, that drove 40% of active inventory last year. All right, so let's break this down. Fannie Mae, how are they looking at this year? What projections have been changed as we move forward here on this January report? Change from where they just were, 30 days ago. The headline on the report, mortgage rates remained a headwind. Okay. So, if you're out there, if you're on the golf course, you don't want a headwind. You don't want wind blowing in the face. It's going to slow everything down. You're going to have to club up. You're going to have to do more with less. You have to figure out a way to navigate that challenge of the headwind. You want the tailwind. You want it coming behind you. Fannie Mae calls these mortgage rates a headwind to home sales. So right there off the bat, they're telling us we're thinking differently about total number of sales. So slower home price growth is also expected on the back end of those, lesser home sales. Let me know in the live chat if you caught the Knowledge Brokers pod. Knowledge Brokers podcast is on a separate channel than the main BAM channel. So I don't know, Haley can link that up there for anybody that's interested. But if you caught last week's pod with Lance Lambert over at Resi Club, and we share a bunch of Lance's stuff. I actually think I have a chart here today from Lance. But Lance said he did a study and he actually talked about it on the pod. I think it was one of the first times. He went back multiple decades to take a look at okay, are most years, what he said, I'm paraphrasing here a little bit. You can go back to the pod and pull it up. Most years are like last year. Okay. Now, coming out of 24, I think a lot of agents would be like, I want 25 to be quite the opposite of 24. Now, a lot of knowledge brokers, a lot of agents, a lot of you guys listening to the Hot Sheet had banner years, but I'm just talking about the averages on the whole. There's a lot of agents that said, gee, I wish 25 would be, double digit increases. And I wish the same thing for the market, for all that impacts a sale. It's not just agents. It's not just, appraisers and lenders. There's so many different, segments of the economy that are touched when a home transacts, right? There's contractors. There's a ton that we do. Home ownership supports so many elements, so many layers of the economy. So yeah, I'd love to see double digit existing home sale increase. in terms of percentage, 10, 12, 15%. That's where some of the more bullish projections coming into the year were, between 10 and 12% on existing home sales. NAR, obviously the most bullish, trying to get a couple brownie points from their members. But you look, and there was some, not as bullish, some very low digit percentile increases on existing home sales at the beginning of the year in terms of projections. And Lance says, expect more of that. Expect more of what the year prior was. He said, when you go back over multiple decades and you look, most years are very close to the year before them. Real estate's got incremental jumps. This isn't Trump coin or Melania coin or Hawk Tua coin, where you could see, this cryptocurrency explode 300% in 24 hours and then come crashing down 24 hours later. And everybody's like, what the heck just happened? Well, that's what happens when you buy very risky crypto assets. Real estate's not that. It's not a risky asset. Look back over the last 4 decades. Even in the year 2000s, when we had the great financial crisis, if you bought in 2000 and sold in 2010, you were up 40%. Yes, real estate went up 80% and had the biggest crash that we've seen from 7 to say 9. But if you bought in 2000 and sold in 2010, you were up 40% on your home. It's very safe. It's very stable. You typically, outside of the mortgage crisis, don't see big crypto-like swings in real estate. So this year will probably be more like last year than it was, or than it will be some big jump. Okay. So that's one of the big takeaways here from this Fannie Mae. They actually downwardly revised this number. Okay. Existing home sales are expected to stay near a multi-decade low. Okay. Total transactions on existing home sales expected to stay near, this decade low. And going back on this chart to 81, when you factor in population, this would not only, multi-decade low, but really low for the amount of population and pent-up demand that we have. So there you go. That's where they're at on existing home sales. That number, to be exact, came in at 4.15 million. Now I'll show you actually speaking of Lance and Resi Club, I'll show you a chart from Resi Club here. Okay. So just a month ago, where was Fannie Mae? Fannie Mae was the 5th most bullish forecast model for existing home sales, kind of meeting the average of 4.22 million for 2025. Okay. They've now revised that down just 1 month later in this existing, on their existing home sale, in this economy report for January. They're down now under 4.25. Okay. So they're in this range down here with the Wells Fargos, the Zillows, the Capital Economics, the Housing Wire, not as low as, say, Goldman Sachs, Realtor, Morgan Stanley. Moody's is acting quite moody about the existing home sale market. 3.74 million. That would be, I think, the opposite of what I just said, where most years are like last year. That would be a significant decline if Moody's comes in right, where, if you go back to some of these top PNC, TD, or NAR, that would be the opposite effect of what, I think a lot of us would be rooting for, a significant increase in existing. It's not even where we would expect to be, in a real estate economy and a growing economy like the U.S. economy and growing population. We would expect to be closer to 5 million or above 5 million if we were just looking at the trend lines of where we should end up. But it's going to take time to get back there. And because of the pressure on the mortgage rates right now, Fannie Mae is saying expect that to be a little bit more drawn out. Here's the table. And by the way, the tables, the charts, make it easy on you guys. Put it right into BAMX so you can download all of the hot sheet show notes. Use that in your marketing and your communications, as well as the charts. Quick access right inside of BAMX. Use code HOT to get the discount on BAMX for all of the hot sheet listeners. But here's where they're at right now This is up to the minute, January 25 forecast. GDP, they're projecting 2.2 every quarter, basically until the fourth quarter here in 25. So 25 comes out at a 2.2 GDP projection. 24 was coming in at 2.5, according to Fannie Mae. So 2.2 this year, on the GDP for 26. So Fannie Mae not buying into some kind of a Trump bump on the economy. 2.2 and 2. Those are pretty, subdued numbers on GDP. And when you're trending inflation at, say, 2%, I don't know what the government's going to look like with government hiring. But essentially it's supposed to be less. We'll see what plays out. But if you're getting inflation down to 2%, which is going to take us more than a year to get there, and you're growing at 2%, I would call that no growth, basically, right? That would be no growth. All right, let's take a look on PCE. So, I mean, look, they don't even have you at 2% on inflation in 2026. Right now, they've got us at 2.4 in 2026. So, they're not bullish on inflation coming down to 2 in the next couple of years. As of this January report, CPI, they have a 2.5 in 26. They have a 2.5 for this year. Unemployment, which we're going to look at this week's, they have at 4.3, so moving up a little bit, and 4.2 in 2026. The 10-year, they have it staying where it is right now, 4.6, and then 4.7 next year. And we know that will, certainly have an impact on the housing market in particular, with the 30-year fixed mortgage rates. I mean, let's take a look at some of these numbers according to this Fannie Mae report, like the 30-year fix. How are they thinking about the 30-year fix? Did this number move up? I have that table for you as well. This is their housing forecast. So 6.7 is where they're at now for an average on the, or 6.6 rather, for the average of 2025. They basically have us, slightly down from where we were last year. Apologies about that if you're viewing this. Last year, 6.7. This year, 6.6. Okay, now it would feel like a move down from where we are right now. It's been hanging around over 7 for the greater part of the past few weeks, but 6.6 is now where they have. That's a move up. They were previously at 6.5. They do have us here in quarter one getting to 6.7 on the 30-year fix, then 6.6 in Q2, 6.5, 6.5 in the last 2 quarters. You look at total housing starts, they're in the 1.3 million range in every quarter. Single family makes up, about 1 million of that, according to Fannie Mae's projections here. Now, total home sales rather, they've projected this down to 4.9 million. Okay, they were up over 5 million last month. That's total. That includes that new construction number. Okay, existing, they're down to 4.15 million. That's the number we just discussed. 4.15 million on existing. That includes single family and condos. 4.15 million. So in 30 days, they've carved off 100,000 existing home sales, 200 sides for Realtor Talk, out of the market due to that increased bump on their forecast for the 30-year fix. So big takeaway for me is Fannie Mae expects a real bump up here, or not a bump, but a bump from where they were on the 30-year fix prior, going to 6.6 from 6.5, and a move down on existing home sales. Okay. They also have, their housing starts, how many starts are going to happen from the builder community. They have that moving down from the prior forecast. Here's your new sales, new construction homes, prior forecast above the current forecast. And again, here's your existing home sale, where you have both dotted lines, prior forecast versus current. They've moved it down not only for 25, but they've moved it down for 26 as well. And until you see, as Logan over at HW would say, until you see the labor market break. Expect these analysts and these projections to be coming in bearish on the 30-year fixed, not moving much. Get comfortable operating high sixes where the majority of these projections are coming in, and get comfortable having conversations with your buyers on waiting for 4 because your friend or your cousin was lucky enough in a crisis-like environment, not like a crisis environment, to get 3 or 3.5 or 4 doesn't mean that's a normal situation on the 30-year fixed, not probably coming anytime soon outside of some crisis. Nobody wants crisis. I don't think anybody should be rooting for crisis. And then as we look at inventory, we do it at the beginning of every single week. Of course, we did it Tuesday this week with Monday being the holiday. We got to understand, and we got to take into consideration the increased inventory reports that we see in mainstream media, that we talk on a headline number nationally. Those are quite different than what you're seeing across the country in certain parts. Okay. If you're in the Northeast or the Midwest, you're not talking about, a significant bump up on inventory. Look at Connecticut, negative 71% pre-pandemic levels of inventory. It's quite a different market than Texas, which has 16% up on pre-pandemic levels. So, this section here, Northeast and the Midwest, northern Midwest region, really still significantly low levels of inventory compared to pre-pandemic. But now you get into the Southeast. Obviously, Florida's 14% up. Texas is obviously 16% up. So they have Arizona, Tennessee, high levels of inventory, 15%. That's a significant bump up from pre-pandemic levels. But some of these other, states, they're dealing with basically pre-pandemic market. Okay, 19%, not much, being down 17, 11, 2, 17, 12, 13. You're really getting to a stable, normal market. The Pacific Northwest looks very much like it did a la 2019, beginning 2020. 1%, negative 2, 7%. So Laura, great point there. Pacific Northwest looking like a normalized 2019, 2020, beginning of pre-pandemic market. And for a lot of these states that are operating in the 7, between the 10% swing in either direction, you're back to a very normal market as it relates to inventory. The only outbalanced market here on inventory right now, you're looking at Northeast, Midwest. Those are dragging down the inventory numbers, while Florida and Texas might be inflating some of these gains. Okay. And so, being able to take those macro numbers wherever you are, that headline readers are going to see, CNBC or CNN, for whatever reason, CNN and Fox News like to throw out housing articles now and again and just confuse the living crap out of people. Not that Wall Street Journal or the Times or CNBC does a better job of it, but they put out headline numbers that your customers, your consumers might say, hey, this is what's going on in the market. It might be quite different in your micro market. It's why I always reference that Ivy Zellman quote. I'll bring it up for anybody that's super new. If you're not new to the hot sheet, I bring this quote up all the time. Okay. I just absolutely love this Ivy. I love this Ivy Zellman quote with the Steve Harney, God rest his beautiful soul, tweet attached to it, because two icons in the industry. We would never suggest that a real estate company, you could change that to agent, could be successful without fully understanding local market trends. But ignoring macro trends or assuming they do not carry the same weight would be equally erroneous suggestion. Okay, you have to be able to balance between the two ends of the spectrum, because your customers, your consumers are seeing a whole bunch of those macro trends, and they're being told that, and then that becomes a belief of theirs about the market. And you've got to ask yourself, as the professional in the market, is that belief that they're seeing on mainstream media serving them? Is that belief serving them well, or are you serving them well? Only you can answer that on what level of education you're providing. All right, let's move over here to where profits are coming in for home sellers. Adam reports that home selling profits are now sliding again as we look back on the 2024 market. And this is despite continued price gains. Okay. So why are these margins shrinking versus, an increase in prices? I mean, we've been going over these prices going up. Seller profit margins for sellers decrease for the second straight year. Typical seller returns remain near high records, though. Okay. So we're really kind of just taking a little bit of those sprinkles off the top of the Sunday because we're still at high records, but declines 54% in this analysis. Returns dip even as national median home prices climb to 350,000. Okay, so here's where they're breaking this down. A home seller made 122,500 profit on typical sales nationwide in 2024. That's a 53.8% return on investment. Okay, so that 54% decline is coming off of a 57%. Okay, so that number there, that's how you got to understand that. Okay, it declines to 54%, not declining a total of 54%. The return on investment, ROI, of selling a house in 24 was 54%. Pretty good investment for the sellers who sold in 24. 54% return on investment. I mean, I get it. You can YOLO on some meme coin and try to hit a home run or lose your shirt. 54% for those that sold in 24 and got the utility of home ownership or the depreciation of renting the property. Those are pretty dynamic numbers there for home sellers. Okay, that came out to an average 122,000 profit. Obviously, that's going to be different for every market. The gross profit on medium price single family home and condos inched up 2,000 from 23, but the typical profit margin stood 8% below that peak in 22. Still, again, near all-time highs. Okay. After a weak 2023, U.S. housing market rebounded nicely in 24. Prices went back up a healthy clip, continued to make some of the best profits on sales in the past 25 years. So generally good news. And there was a little bit, obviously, of that dip off, and it's worth following in 25. Home prices are stretching household budgets more and more, and mortgage rates have gone back up in recent months. So there's certainly some factors that could propel the market up or down. Either will have a significant impact. And so there you go on this report. Here's some of the here's how to view these seller gains. The peak in 22 was 62%. 57% in 23, 54% in 24. 24 would be above 21 levels of 50%. And I mean, we go pre-pandemic, sellers were getting 31% return on investment in 2019. So up significantly from those levels. And listen, in 24, you've got some sellers, that bought in 22, in 21. And so, that's where you're going to see a little bit of that number cool off a little bit there, as opposed to just continuing to swell. Probably a healthy thing for the market. All right, let's take a look at unemployment, see if it's trending in a healthy direction for our fight against inflation. For the week ending January 18th, initial claims came in. This just released, of course, this morning at 8:30 a.m. Eastern time. Initial claims came in at 223,000. That's an increase of 6,000. Previous week's unrevised level was 217,000. 4-week moving average also increased 750 from the previous week's average. That comes in now at 213,000. But generally speaking, unemployment kind of moving sideways. We're not seeing a significant bump up there, which is, not going to be great news for the 10-year. 10-year is not going to react much to this. I think it's great news for the citizens in your community and in our country and all of that. We want people to be employed. Just remember, we can't have our cake and eat it too. If we want maximum employment, which is a mandate of the Fed, you're likely to see rates higher for longer. And And so unemployment moved up a little bit. If it moved down quite a bit, that would be actually a concern for inflation. So running at this, low 4% number is probably going to keep things relatively where they've been here today anyways. 4.65 on the 10-year. That's where we're at. If we just take a look at the last 5 days, we're at a high point going 5 days back. But if we go back a month, we're not at that 4.8 level, which was the high for the last 52 weeks. Looking at the 30-year fix yesterday, came in at 7.08. That's now 3 straight reads, according to Mortgage News Daily's daily survey. 3 straight reads at 7.08. Sorry. And then the one prior to that was 7.07. This is how these numbers right here on your screen. This is how 30-year fixed rates used to move. Not much at all. 30-year fixed rate was a pretty boring thing to talk about because it just barely moved. And then we've seen, obviously, since the middle of 22, we've seen a lot of volatility and sharp moves in the 30-year fix. But, what we've seen the last 4 days is a little bit more of a historical norm. By the way, still 3/4 of a point below the 50-year average on the 30-year fix, and not moving much is more normal. Okay. There we go. That's your hot sheet here. That's the last hot sheet of the week. Appreciate you guys. If you haven't done it, make sure that you sign up for February 5th's Pro Bowl event, Pro Bowl number 2 from BAM, the BAM Pro Bowl. We've got a new speaker to announce. Sharon Srivatsa is now going to be joining us and talking about something he barely ever talks about. Most of the stuff you've heard from him in 24 is tactics and all of that kind of stuff for agent tactics, how to deal with the commission changes. We're going to be having a conversation with Sharon at BAM Pro Bowl about creating scroll-stopping content and community that every agent can use to leverage in their business in 25. Jared's going to be talking about the new way to prepare and win in this 2025 market. So we've got Sharon and Jared and speaking of local community, the local community YouTube king himself, Ken Pozak, Tina Call, talking 6 types of working genius, as well as Kofi Narte talking some luxury, attracting high net worth clients, raising that price point. Myself and the broke agent doing the play-by-play commentary, a ton of fun and entertainment mixed in. BAMProBowl.com. Get your free spot today. We are capping out that event just based on the virtual platform. We're gonna have more people that want in that actually get in. And BAM Pro Bowl, BAMProBowl.com is where you sign up for that free event. It's also not going to be replayed. Just if you sign up, you don't get the replay. You got to be there live, or BAMX members, you'll have the replay into infinity in the BAMX platform, of course. All right. There's your hot sheet. I hope everybody has a great Thursday, has a great weekend. I hope we can come in here next week and see another 7 days of data of, things moving up. I'm hoping that for all of you guys, an active weekend on your real estate ventures. And until next time, of course, toodaloo.